Welcome back to the deep dive. If you've been anywhere near the financial news or, well, frankly, just watching tech over the last couple of years, AI it's huge. One of the most exciting investment areas maybe of our generation.
Oh, absolutely. We're talking about the potential for real, lasting, generational wealth here. It's driven by this massive shift in compute power.
The potential is definitely there, but, the ride isn't exactly smooth.
Not at all. That's the thing. The environment we're in now, it's anything but calm.
Mm.
And that promise of wealth, it doesn't just happen linearly.
No.
We got a really sharp reminder recently, didn't we? Painful even. Just how volatile these growth stocks can be, especially the ones right at the cutting edge like AI.
Yeah, and often hit by things totally outside their own performance, right? Macro stuff.
Exactly. Things completely outside their quarterly earnings reports.
Which brings us to what happened at the start of October. We really need to look at that because it was such a clear example of how systemic risk can just ripple through that whole AI value chain.
It really was.
Specifically, the NASDAQ composite took a brutal hit on October 10th. What was it, 3.6% down?
3.6%. Yeah, and that number might sound a bit dry, but that one day, that was the worst session we'd seen since April.
Back when trade tensions were really flaring up before.
Right. And it just screamed, that geopolitical risk. It's not some side note for AI investors. It might be the single biggest threat, at least to short-term values.
Because when fear spikes.
When fear spikes, those high-flying growth stocks are the first things people dump. First out the door.
Okay, so let's unpack that trigger. The geopolitical shock, because it gets right down to the actual stuff needed to build this AI future. The volatility was a direct reaction to U.S.-China tensions escalating again.
Yeah, and what's really key here is how it escalated. The U.S. threatened that huge additional tariff, 100% on Chinese imports.
Wow, 100%.
But that was retaliation, right? It was because China moved first, putting stricter export controls on some really critical inputs.
Which were?
Rare earth minerals and magnets.
Okay, and maybe for someone listening who thinks, rare earths, minerals, I own cloud stocks, why do I care? Make that connection crystal clear.
Because they're absolutely essential. You can't get around it. They are the basic building blocks for high-performance computing, for specialized cooling you need in data centers, really across huge parts of the economy, and critically, for making advanced semiconductors and all the tech equipment that powers AI.
So no minerals, no advanced chips, no advanced chips?
No AI acceleration. Exactly. It's like trying to build, I don't know, the most complex engine ever, but suddenly your supplier for the special steel or the critical lubricant, they're cut off.
The whole thing grinds to a halt.
The whole line stops. If you mess with the supply of these basic rare earths, you're messing with the entire AI value chain, from making the chip itself all the way to running large language models in a giant data center.
And it wasn't just a threat that fizzled out. Those reports on October 12th, China basically said they weren't backing down.
Not backing down. That ongoing tension, that uncertainty, that's precisely why smart investors can't just look at revenue growth anymore. You have to think about resilience. You have to.
Which brings us to our mission for this deep dive.
Exactly. We're not really here to just point out, buy the dip opportunities, although those might pop up. Our focus is helping you, the listener, avoid the really costly mistakes, the structural ones that can wreck a portfolio before the next shock hits, whether it's geopolitical or just market-driven.
So we're framing this around 3 pillars, right, for succeeding in this tricky sector.
3 essential pillars: diversification, sensible position sizing, and maybe the most crucial one, real unshakable conviction.
Got it. So it's less about just picking the winners and more about building like a structural defense for your AI money.
That's the goal.
Okay, let's dig into mistake number 1. This feels like maybe the most common trap, especially when everyone's excited about AI, people think they're diversified, they hold maybe 3 or 4 different big AI names, but actually their portfolio is super concentrated, all clustered in just one little part of that AI value chain.
It's classic behavioral finance, isn't it?
Yeah.
You look at your account, you see different tickers, NVDA, AMD, AVGO, and you feel safe. You think, okay, I haven't put all my eggs in one basket.
But it's not about the ticker symbol.
No. True diversification isn't about the company name. It's about the underlying business risk. It's about who their customers are, if they share the same customers, the business cycles they depend on. That's what matters.
So let's use the classic example, chip designers and investors feeling pretty good. Maybe they own NVIDIA, Broadcom, AVGO, and maybe AMD too. 3 different huge companies in AI chips. Feels diversified. So what's the flaw? Where's the hidden trap?
The flaw is actually pretty simple when you look closely. The revenue funnel, where the money's coming from,
Honest.
it's often way narrower than it looks on the
How
surface.
so?
Because these companies, even though they compete, they often share the exact same really big customers, the ones driving the bulk of their AI growth.
Okay, give us a concrete example. Tie that risk together.
All right, think about the massive build-out happening right now. Foundational AI infrastructure. You've got giants like OpenAI,
Huge player.
one single massive customer in this market. And guess what? They're buying chips from all three of those companies you mentioned. NVIDIA for the main training GPUs, AMD for maybe some competitive options, Broadcom for things like specialized networking chips, accelerators.
So OpenAI needs tech from all of them.
They do, especially as they aim to build out, get this, 10 gigawatts of data center capacity.
10 gigawatts, that number, it's just hard to wrap your head around. What's the comparison?
Like multiple nuclear power plants? Yeah, roughly the capacity of maybe 3-4 large nuclear plants combined. More power than some entire small countries use, or, many big cities.
Okay, so it's not just a big number. It's a colossal capital spending commitment by OpenAI.
Astronomical.
Yeah.
So if you're concentrated just in those chip designers, NVIDIA, AMD, Broadcom, and one huge customer like OpenAI suddenly faces, say, a budget issue.
Or regulators make them pause.
Or just the whole economy tightens up, and they have to cut back on that massive capital spending. What happens?
The earnings for all three chip companies get hit simultaneously.
Simultaneously. Your supposed diversification? Poof, gone. Because all three stocks are ultimately tied to the same core risk factor, the spending decisions of just a handful of hyperscalers or big AI labs.
So the stocks might wiggle around differently day to day.
Sure, daily noise.
But the systemic business risk, that potential single point of failure in the customer base, is basically the same across that whole chip design segment.
Absolutely. If that funnel gets clogged, they all feel it.
Okay, this concept clearly goes further up the chain, too. It's not just the designers feeling this. Let's move one step earlier. The companies that make the machines that make the chips, the equipment suppliers.
Right, the really foundational companies. The ones designing and building those incredibly complex tools you need to manufacture the chips. We're talking the giants. Applied Materials, Lam Research, ASML.
Again, different companies, different specialties,
Yeah.
right? Based in different places.
Totally. Different parts of the process, deposition, etch, lithography. But they fall into the same trap.
Okay, so who are their shared big customers?
It's the chip manufacturers themselves,
Yeah.
the fabs, the fabrication plants, and who dominates advanced chip making.
Taiwan Semi.
TSMC, Samsung Electronics,
Yeah.
and Intel, trying to catch up. Those three, mainly.
Okay, let's use an analogy maybe. If TSMC is like the world's most advanced exclusive bakery, what are Applied Materials, Lam, and ASML?
Okay. They're the ones providing the super specialized custom-built equipment. ASML gives them those multi-million-dollar EUV lithography machines. Those are the critical ovens, let's say.
It's a key technology.
And Applied Materials, Lam Research, they provide all the other specialized gear, the mixers, the quality control, the deposition tools, all the stuff you need around the oven.
Got it. So the systemic risk becomes obvious now. If the bakery, TSMC, decides, you know what, we're cutting back next year, we're only building half the new factory lines we planned.
Yeah.
It doesn't really matter whose oven is slightly better or whose mixer is fancier.
Just exactly. TSMC cutting its spending plan becomes your single point of failure risk if you're only invested in equipment makers. If one huge customer like Taiwan Semi slashes its budget for new manufacturing lines, it just reduces demand for all that advanced equipment.
So Applied Materials, Lam, ASML, they all suffer together.
They suffer together. You thought you were diversified by picking different tool makers, but really you were just betting on the CapEx plans of the same handful of giant fabs.
Okay, so this really hammers home the need to diversify beyond these concentrated layers. Let's go further down the chain. The companies actually using all these chips and deploying the AI models, the cloud giants,
Right.
Amazon Web Services, AWS, Microsoft Azure, Google Cloud, Oracle's cloud infrastructure, too. These often feel like the safest AI play, don't they?
They do offer a degree of safety, yeah, because they're enormous. They're established businesses,
Yeah.
and they're more diversified within themselves. They do a lot more than just AI. General compute, storage.
But they definitely benefit massively from the AI boom. Every big model needs training, needs inference. It runs on their infrastructure.
Hugely. They capture a huge slice of that spending.
But you mentioned a caveat earlier. Even with their scale and broader business, where's the hidden concentration risk for the cloud providers?
The caveat is that their core business, a huge chunk of it, is still tied to general enterprise IT spending,
Yeah.
global corporations deciding how much to spend on tech overall.
Okay.
So if we hit a really significant widespread economic downturn, what do corporations do?
They tighten their belts across the board.
They slow down those big digital transformation projects. They might delay migrating more stuff to the cloud. They cut back on general compute usage to save money.
So in that scenario, even if AI is still growing faster than old school IT, all four of those big cloud players, AWS, Azure, Google Cloud, they'd likely see demand slow down at the same time.
Very likely, yes. The overall tide goes out. So now you're not concentrated on one chip designer or one fab's plans. You're concentrated on the health of the entire global enterprise spending environment.
A different kind of concentration risk.
A different kind, but still concentration. A major economic shock still hits all of them broadly. That diversification you thought you had among the four cloud giants gets neutralized to some extent.
Wow. Okay, so bring this all together. What's the actionable takeaway for someone listening trying to build a resilient AI portfolio?
The bottom line is this. Real resilience in AI investing has to be built across the value chain, not just within one segment.
So practically, what does that look like?
It means maybe you own a couple of the leading chip designers, yes, but also maybe one or two key equipment suppliers and some exposure to the big diversified cloud providers. Maybe even some companies focus purely on AI applications further down the line.
Mixing it up across the levels.
Exactly. The whole strategy is designed so that if one part of the chain gets hit hard, say, equipment orders suddenly slow down, it doesn't cripple your entire AI allocation because maybe the cloud layer or the application software layer is holding up better.
It's about diversifying the risks and the customers.
That's the key distinction. Diversify the risk factors, diversify the customer bases. Don't just diversify the ticker symbols. That's how you build a portfolio that can actually absorb a shock to one part of the AI ecosystem without collapsing.
Okay, we've spent a good chunk of time on what stocks to own, the portfolio's composition across that value chain. But that's only half the battle, right?
Only half, absolutely.
If we're serious about building resilience against this crazy volatility, we have to talk about the mechanics. Specifically, how much of each stock you actually own, position sizing, allocation.
Yeah, ignoring this is just as dangerous as picking the wrong stocks. Maybe more so sometimes. Because sizing dictates your ability financially and, crucially, psychologically, to actually ride out the inevitable drops.
This isn't just stock picking anymore.
No, this moves us firmly into risk management. Personal finance, really. You could, theoretically, pick the single best AI stock for the next decade. But if you size it wrong,
What happens?
two bad outcomes. Either the position is so tiny, its amazing success barely moves the needle on your overall wealth, or maybe worse, its unavoidable volatility scares you into selling at the absolute worst moment because the dollar amount swinging around is just too big for you to handle.
Which leads us to what you called the sizing paradox. Can you define that balance we need to strike?
It's a real tightrope walk. On one side, you definitely don't want to be so diversified, holding like 50 tiny positions.
Diversification.
Exactly, diversification. Where your best ideas, the companies you've researched like crazy and have the highest conviction in, are just too small to make any real difference to your long-term returns. You're basically trading away meaningful upside for, well, mediocrity.
Okay, but the danger on the other side feels much scarier.
It is. Way more acute. You absolutely cannot afford to be overly concentrated. Letting just a handful of these high-growth, very volatile AI stocks become too big a percentage of your total financial picture.
Because if they take a hit,
If those few big positions suffer a completely normal correction for growth stocks, say 30%, 40%, even 50% down, that could cause catastrophic damage to your overall financial health. It could force you to sell other things, abandon your plan. Just devastating.
So obviously we can't say, put X% in this stock. It's personal. What's the framework? How should a listener think about sizing their bets in a sector like AI, knowing how wild it can be?
Right, no magic number. You have to align the size of any position with three main things about you. They're all interconnected. First, your investment goals. Second, your investment time horizon. And third, the trickiest one, your genuine risk tolerance.
Not just what you say your risk tolerance is.
Exactly. Your actual capacity for handling loss, not just the theoretical idea of it.
Okay, let's break this down. Goals and time horizons seem a bit more straightforward. How does an AR position look different if I'm saving for retirement in 30 years versus, say, a house down payment in 5?
Massive difference. If retirement is decades away, your time horizon is your superpower. Market volatility, like that 3.6% NASDAQ drop we talked about, or even a stock falling 50%. Over 30 years, that's likely just noise on the long-term chart.
Time smooths it out.
Time is your best friend. It lets you recover, lets compounding work. So someone in that position might be able to justify larger starting positions in these high-growth, high-volatility names, especially if they're still adding new money regularly.
Okay, but what about the person who's more risk-averse or has that defined shorter-term goal, like the down payment?
That person is fundamentally constrained by needing that capital relatively soon and relatively intact. They can't afford a 50% drawdown that might take 3 or 4 years to claw back from. Capital preservation becomes much more important.
For them.
For them, they absolutely have to limit the size of any single high-growth stock position within their overall portfolio. Maybe they lean more towards diversified ETFs that track the whole AI sector, rather than making big concentrated bets on individual companies. Much smaller individual stock positions, if any.
Okay, that makes sense. Now, the tough one, risk tolerance. It's so subjective, so emotional. How does someone listening get a real handle on their true tolerance beyond just nodding and saying, yeah, I can handle risk?
That is the challenge, because honestly,
Yeah.
most people dramatically overestimate their risk tolerance
Uh-huh.
until they live through their first really big, scary, sustained market
Like
drop.
paper losses feel different than real ones.
Completely different. So the best way to try and quantify it to make it less fuzzy is to ask yourself a really hard objective question. What is my maximum tolerable drawdown? My MTD.
MTD, maximum tolerable drawdown. I like that. So how do we use that MTD figure to guide position sizing?
Okay, let's say you do some soul searching.
Yeah.
Look at your finances and decide the absolute maximum drop you could stomach in your entire portfolio value without completely panicking and selling everything is maybe 20%.
Okay, 20% overall portfolio drop is my panic point.
Right. Now, you have to work backwards. Let's say you really love NVIDIA and you let that position grow to become 20% of your total portfolio.
Big position.
Big position. Now, remember that historical drop NVIDIA had in 2022, over 55% down from its high. If that happens again, and your NVIDIA position is 20% of your portfolio, that one stock falling 55% would wipe out 11% of your entire portfolio's value. 0.205 is 0, 0.55 kills 0.11.
Wow. So just one stock gets me more than halfway to my absolute panic point of 20% total drawdown.
Exactly, just that one volatile stock. Even if everything else you own is perfectly stable, holding that one high-risk stock at a 20% allocation puts you dangerously close to your personal psychological breaking point.
So the MTD framework forces you to connect the position size to the stock's specific volatility.
Precisely. Highly volatile stocks, like many in the AI growth space, just by their nature, their potential for those 30, 40, 50% drops, they demand a smaller position size compared to, say, a stable utility stock.
Yeah.
Regardless of how excited you are about the company's future, your MTD dictates it.
I see the logic, but let me play devil's advocate for a second. If I cap my positions too tightly, aren't I just guaranteeing I won't really cash in when the AI boom truly happens? Isn't focusing so much on sizing just market timing in disguise, trying to avoid the crash instead of maximizing gains?
That's a fair point, a really common concern.
Yeah.
But I'd argue sizing isn't about timing the market, predicting the crash. It's about managing behavioral finance. It's about protecting yourself from yourself.
How so?
Because if you size correctly, according to your MTD and time horizon, you ensure two critical things. First, that a bad downturn in that one stock won't torpedo your ability to reach your essential life goals. And second, maybe even more importantly, you ensure the position is small enough relative to your total wealth and tolerance that when the stock inevitably drops hard, you can actually handle it emotionally. You can hold on, maybe even add a little more if your thesis is intact.
But whereas if the position is too big,
If the position is too big, the fear becomes overwhelming. The dollar amount dropping is too scary. And that's when investors make the single most costly mistake: selling near the bottom out of panic. Correct sizing prevents that panic sale.
so position sizing is like the ultimate structural defense against making that catastrophic emotional decision.
It really is. It's about aligning the investment with your personal financial reality and your actual tested ability to handle losses, not just your enthusiasm. If the position's too big for you, the market's volatility will eventually force your hand, usually at the worst possible time.
Right, we've built the frame, diversify across the value chain, size positions appropriately for you. Now we get to what I think might be the greatest mistake of all. The one that really separates long-term wealth builders from, short-term gamblers in this AI space.
What's that?
It's focusing just on stocks. The ticker symbols, the charts, the daily price wiggles, instead of focusing on the companies. The actual businesses, their competitive advantages, their potential decades from now.
Ah, yes. Lack of conviction. You can have the most beautifully structured, perfectly sized portfolio on paper. But if you, the investor, don't truly believe in what you own when things get rough,
Yep.
it all falls apart.
Because volatility isn't an accident in these
It's
sectors.
not a bug, it's a feature, especially in high-growth areas like AI. High valuations, extreme sensitivity to interest rates, geopolitical shocks. Volatility is guaranteed. And if you don't have conviction, that volatility will chew you up.
This takes us straight back to that timeless advice from Peter Lynch, doesn't it?
Absolutely. Know what you own and why you own it. It sounds so simple, but it's profound. If the only reason you bought, say, a chip stock is because it shot up 50% last quarter,
You're chasing momentum.
you haven't bought a piece of a business. You've basically bought a lottery ticket based on recent price action. There's no anchor there.
And that lack of an anchor, that lack of real understanding leaves you totally exposed when the market turns.
Totally exposed. Without genuine conviction, rooted in actual research and understanding of the business, you get this toxic mix. Emotion meets volatility. And that combination just corrodes the foundations of even a portfolio that looks strong on paper.
What does that corrosion actually look like? What's the behavior?
It means people sell, usually at the worst time during the panic. They might have held the stock while it was going up, feeling smart,
Sure, easy then.
but their investment thesis was just, it's going up.
Yeah.
The second it reverses, the second that fear floods the market and those paper gains turn into real scary losses, they bail.
Why?
Because they never had a fundamental non-price reason to own it in the first place. They bought the ticker symbol, the stock, not the underlying company.
So let's talk about the ultimate test for conviction. You called it the sell-off test. How do we know if our thesis, our belief in a company, is strong enough to survive one of these brutal downturns?
The best investments, the ones you'll likely hold for the long term, are the ones you feel genuinely confident owning, even if they go through some crazy, extreme, seemingly illogical sell-off.
So conviction means?
Conviction means you understand the business and its competitive position so well that when the price drops hard, you see it primarily as a drop in valuation, not necessarily a drop in the quality or long-term prospects of the business itself.
If you truly believe you own a great company,
Then a big price drop should make you question the market's short-term sanity, not necessarily your own long-term investment thesis.
okay, let's make this concrete. Let's use NVIDIA again as the test case, because it's the perfect example. Unbelievable growth, but also just gut-wrenching volatility at times.
Perfect example. Think about two investors. One bought NVIDIA purely to make a quick buck, just riding the AI hype wave, pure speculation.
Investor number one.
Investor number two has done the deep work, understands the CUD ecosystem, the data center strategy, the competitive landscape. They have real conviction. Now, market hits turbulence.
How would investor number one react to those big historical drops NVIDIA has had? Remind us how big those were.
Well, recently we saw it fall over 37%, just from its highs in early April. That was mostly driven by those renewed trade tension fears we discussed earlier, market noise, basically.
37% is a huge hit in a short time.
Huge. But go back further to the broader tech bear market in 2022. NVIDIA dropped over 55% from its previous highs then.
Losing more than half your investment in the absolute poster child of the AI revolution, that
Yeah.
tests anyone.
It absolutely does. So how does the conviction investor, investor number two, look at that 55% plunge differently than the speculator?
What's their process?
The conviction investor doesn't just react emotionally. They reevaluate. They ask fundamental questions. Has the competitive moat shrunk? Is CEDA still the dominant platform locking developers in? Are competitors suddenly making huge inroads? Is the core business strategy failing? Are margins collapsing?
They're looking at the business, not just the price.
Exactly. And if the answers to those fundamental questions are still, no, the business is strong, then they conclude that a 55% drop driven by macro fears, like interest rates, or general market panic, is largely market noise relative to the company's multi-decade potential.
They see the price collapse, but believe the company is still sound and executing.
Right, that conviction, that understanding, provides an essential psychological buffer. That investor might see the 55% drop not as a reason to panic sell, but maybe even as a temporary discount on a great long-term asset. It makes it far easier to hold on or potentially even add to the position.
And the speculator, investor number one.
sees the stock price collapsing, assumes the whole AI story is over or that they were wrong, panics, sells, and locks in a massive loss.
Because they confuse market noise with fundamental breakdown.
That's the absolute core difference. Confusing short-term volatility driven by headlines, tariffs, interest rates with a permanent deterioration of the company's actual business prospects or competitive edge. Long-term success in volatile sectors like AI isn't about nailing the market timing. It's about making consistently good decisions over an extended period. And a huge part of that is holding on to great companies through the noise, which requires conviction.
So it sounds like the biggest benefit of deep conviction is simply resilience. Resilience against fear itself.
It is. If you lack conviction, fear drives your decisions. And fear almost always tells you to sell at the worst time. If you have conviction rooted in research and understanding, you rely on logic in your long-term thesis. That process, that mental fortitude, is what lets you survive a 55% drawdown and actually be there to participate in the eventual recovery and growth. Hashtag outro.
Okay, this has been incredibly helpful, I think. Moving the conversation from just what AI stock is hot to how do I build a system, a structure, to actually invest in AI resiliently. Let's pull those three main pillars together one last time for everyone listening.
Sounds good. We covered the three absolute foundations for building a portfolio that can hopefully withstand the volatility we know is coming. First was diversification. And crucially, not just owning different tickers, but spreading your risk across the AI value chain.
So owning some chip designers, some equipment makers, some cloud providers.
Exactly. To avoid that hidden concentration where maybe everyone secretly depends on OpenAI's or TSMC's spending plans, diversify the real underlying risks.
Got it. Pillar number 2.
Portfolio sizing, the mechanics. Making sure the amount you invest in any single stock aligns with your personal situation, your actual risk tolerance, remember MTD, your goals, your time horizon.
The goal being?
The goal being to size positions so that even if a stock experiences its historically worst drop, it doesn't blow up your whole portfolio or, just as importantly, force you into a panic sale because the dollar loss feels too big.
Okay. And the third pillar?
Conviction. Invest in companies you genuinely understand and believe in for the long haul, not just trading tickers.
Because that gives you the strength to.
It gives you the psychological strength, the fortitude to tell the difference between temporary market insanity, like a 37% drop on tariff news, and a real fundamental problem with the business. Conviction lets you hold on because you believe in the company, not just the recent price trend.
Right. So when you put all three together, diversification across the chain, smart sizing, deep conviction, you're essentially building something specific for this environment.
Yeah, you really are. We like to think of these components creating an investment suspension system for your portfolio.
Okay, I like that analogy. Unpack it.
Think of it like a vehicle built for rough terrain. Diversifying properly across the value chain, that's like having a wide, stable chassis. It spreads the load, gives you a solid base.
Okay, chassis is diversification. What about sizing?
Sensible position sizing. Those are your high-quality, long-travel shock absorbers. They're crucial. They absorb the impact of the big bumps, the sudden drops in individual stocks, and prevent that shock from rattling the whole vehicle apart or throwing you off course.
Makes sense. They dampen the volatility's impact on the overall portfolio. And conviction.
Conviction is your steering wheel and your engine. It keeps you pointed in the right long-term direction, focused on the destination, even when the road gets incredibly bumpy or visibility is poor. It stops you from swerving wildly or slamming on the brakes every time the market gets scared.
So the whole system, chassis, shocks, steering, lets you navigate the rough patches without crashing.
Exactly. It allows you to absorb those big sell-off shocks, maintain your direction, and keep moving forward, even when the terrain is trying its best to shake you apart.
That's a really powerful way to think about it and a good frame for looking ahead. Because let's be clear, AI stocks have delivered incredible returns. That potential for generational wealth, it feels very real, maybe unprecedented.
It does feel real. But, and this is the crucial but we have to keep repeating, those massive gains, that wealth creation, it will take time, a long time. And the journey is absolutely going to involve more bumps, many more.
More 3.6% NASDAQ drops are coming. More 55% corrections in individual darlings are probably coming.
Guaranteed. We just don't know when or exactly how severe.
Which leads to the final thought, the provocation maybe.
It's this, trying to guess the timing or the severity of the next sell-off. It's a fool's errand. Nobody can do it consistently.
So where should the effort go?
Your time and energy are far, far better spent focusing on following great companies, understanding their businesses deeply, and diligently working to limit these three big structural mistakes in how you build and manage your portfolio. Focus on your process, your diversification, your sizing, building your conviction.
Control what you can control.
Exactly. Control your process, control your risk management, control the depth of your own understanding. Don't try to control the market's unpredictable swings.
Excellent guidance for any investor navigating these exciting but choppy waters. Thanks for breaking that down.
My pleasure.
And for everyone listening to the deep dive, we really hope you take these lessons to heart. Start applying them today as you review your own holdings and stress test your approach to AI investing. Thanks for tuning in.